Hello, I'm glad to see you join us in this episode of Street Smart Business Show, where we bring to you discussions around business dealings for entrepreneurs and aspiring entrepreneurs. In the last edition of this show, we had a special guest who had a very good understanding of the topic we wanted to discuss. He came on board and did justice to the discussion around business funding and financing. Mr. Samuel Nwanze, our guest, a fantastic and a great professional in the field of investment, financing, and funding of businesses, helped us to demystify the challenges and the issues that businesses usually run into when it has to do with helping their businesses to have the necessary cash. He talked about something very important that businesses must have to survive, and that is cash. Cash is important. And he said the second part of it is that if you must have to succeed as a business person, you must make sure that that same cash is available in your business. So, in this episode, we are taking this discussion further because he opened our minds to opportunities out there, and he made it look as though it's us that we do not get to know what we should do, things we should do, the buttons we should press to get our businesses funded as and when due. So in this particular edition, he will be taking the discussion further with us, and that discussion will be on debt funding, specifically loan and investment, maybe the likes of equity contribution, angel investor, what have you, that time will permit us to have on this show in this particular episode. So welcome once again, and I'm sure you're going to have a great time. So to our guests, thank you so much for coming around, Mr. Samuel Nwanze, for coming on the show. It was awesome the last time you were on the show with us. We were enlightened about those things that ordinarily entrepreneurs take for granted, and though we complain about a lot of things, we see that the missing link is just about what you know and what you should do, that you're not aware that these are the ways you could go about them. Okay, so the discussion on business financing and funding, which we started off the last time, is same thing we're going to take further. But this time around, we'll just drill down to two key areas where we have entrepreneurs, business owners have been playing one or two roles, or been making so much efforts, maybe because they feel it's one of those things that are easily accessible or they come by here in this part of the world. Let's say particularly Nigeria, for example, okay, and which is the debt type of funding, more of the loan now, and investment, which has to do with the equity and every other thing associated with that. Okay, you touched on them the last edition. So I think what we can start with in this edition now is to first of all look at a business owner and his quest for funding at this moment. Someone who is already in business and he has done a lot of things. He probably have made some effort, and at a point I've heard somebody talk about had issues. They said credit rating was a problem or something. So are there those things that business owners needs to now, particularly do and make sure that it's intact if it is going to be debt funding now, and intact if it's going to be for investment financing in terms of equity contribution or what have you?
Yeah, I mean, great question. Let me start with debt. Or with loans. Let's call it loans. First is, or let me take a step back. What I would normally advise any business is, as much as possible as you can, try and fund your business with your own capital, because there's a cost to money.
That is at the start.
Startup.
Okay.
Yeah. And even as you go along, as much as you can, there's the concept of bootstrapping, where you are squeezing as much as you can to push the business more in a direction where you are doing what you can with your own resources, or resources you can gather without necessarily plugging into external forms of financing, to get the business to a stage. The reason is because money comes with a cost. And some of that cost is monetary cost, but some of it is also control cost. Yeah. The more you have external parties participate in your business, whether in form of loan or equity, the more you are giving up something in terms of either return or the level of control you have over your business. So what I always advise is, as much as you can, try and fund your business with your own cash. When it comes to debt, there are a couple of things that are important to bear in mind. Number one, always see loans as leverage. And what I mean is, when you're talking about leverage, you are basically taking something that you have and trying to get more out of something that you already have. So loans must be seen as, you have cash flows that you are generating, but those cash flows are not sufficient enough for you to take the business to a level. So you need leverage, to take that cash flows that you have over a period of time and get bulk money now to do certain things that make the business even bigger and generate even more cash flows. So always see loans as leverage, because and when you're looking at the loans, you have to think of a couple of things. You have to think about tenor. How long do I want to take the loan? Oftentimes, most entrepreneurs, they just want the money without taking into account what would be best for them in terms of the tenor of the loan, or they make false promises and then they run into problems. So you look at tenor of the loan, look at the size of the loan. You want as much as possible to take a loan of a size that fits with, how you are going to generate cash over a period of time. And then you don't have to take something enormous or something too little. You have to determine what is the right size, and then as you grow, you can expand or shrink depending on what your business needs. And then third is, you always have to look at the pricing. And I know it's a difficult thing in this environment where pricing is really dictated by it's a one-way street. The provider of funds say, this is my interest rate, and you have to live with it. But you have to consider what impact that pricing has on your cash flows and your ability to generate return. Sometimes you take a loan, you may not make much money as the business, but that loan helps you to take the business to another level. Yeah, do you understand what I mean? Okay. So you have to look and think about all those things, the terms that you have on the loan. And then when you're looking at equity, again, most times equity, and that's, people don't realize it, but that's probably the most difficult or the most sensitive form of capital that you can get, because it's the most expensive. In an equity type scenario, you're actually going into a marriage as opposed to you dating somebody, and the implications for your business can be magnified. It can make or break your business. You can actually, to get the right equity partner who is bringing money and bringing more than money, it can take your business to another level. So whenever you're thinking about equity, don't just think of the cash the person is bringing, but think about what else can this person bring to help me grow my business, because you are going into a relationship. And you also have to think about how you value your business so that that equity comes in a way and manner that you don't lose total control. And that's why the first point I made around bootstrapping and funding as much as you can with your internal sources is extremely important. So I'll leave it at there at this time.
Thank you so much. That's fine. That's very insightful about having to look at things to consider in terms of loan and investment as you make those key decisions about which one and when in the business. So I would now put it this way to be able to say for an entrepreneur who is not considering maybe a loan, for example, now, and he maybe at the point of even getting it or he has gotten it, what would be your advice in ensuring a healthy loan portfolio now that he's able to or he's about to just even being credited or sign a deal to that? How can they be able to maintain a healthy loan portfolio?
No, yeah, it's a good question, and it's a very important question. Your ability to be able to access into bigger and bigger financing as a business, whether debt or equity, is dependent on how well you use the existing one that is given to you. If you use it well, manage it well, and people can see that there's a track record of you being able to manage money well, then people will be more comfortable to give you more. So always, treat money that you borrow as one that you must make sure that you repay, because it speaks a lot to one of the 5 C's. Remember, I talked about the 5 C's of credit. One of those 5 C's is what is called character. And when somebody is analyzing the loan, is looking at the question of character, saying, is this a guy who repays his loans? Yeah. If there's a credit rating system that helps to establish that, that's great. But if there is none, they will check as to what have you borrowed before and have you repaid. It can be as simple as how easily or quickly you pay your phone bills nowadays, because they run algorithms to see whether you owe other people in different small things to determine whether you are credit worthy. So very important. So by doing that, some of the things that you need to look at in terms of managing, again, it goes to this principle of cash management. Business is really a lot about, especially when it comes to the finances side, how well you manage your cash. And I talked about this the last time. Always think of maximizing cash in and minimizing cash out. Always think about that. Anytime you have to write a check on your business, ask yourself, do I need to write this check? Is this the best use of my capital at this point in time? Are there other things I can do for now? Can I manage the person I'm supposed to pay to delay it for a few days? Always think about that. On the cashing side, always look at do I have money that I'm being owed? How do I get any money that I have outside in? Yeah. So basic principles on how you manage your cash is extremely important. So when that loan comes in, money has come into your business, you have to put in a system that is tight in terms of how you utilize that fund. And each time you are utilizing it, you remember it is for leverage. If you take a loan and you use the loan to satisfy, some people do this, they take a loan and the first thing they think about is they go and buy a car. See, now I have the money in the system, let me buy a car to present my status. You may be in a type of business where the car is important, but you may be in a business where the car is not what is important. So you have to look at, as I'm about to spend from this loan, is it leverage or is I'm just satisfying a want as opposed to a need that will generate cash further down the line? Extremely important principle that if you bear in mind, it helps you to better manage monies that you take in.
So are there pitfalls that one should be mindful of in loans, especially when you're signing the deal? Are there specific causes, one or two things that you, by experience, that you would advise entrepreneurs to watch out for before they ink that deal?
Absolutely. I mentioned in the last time we had the conversation that a loan is a legal obligation. It's a legal obligation that you have to give money back to the person who has given you that money with the return. And if you fail to do so, the law allows that creditor to take over your business. And you have to be mindful of that whenever you're signing any loan agreement. A couple of things to look out for. So number one is, I mentioned some of the things that are embedded in a loan, the terms of a loan, your tenor, your pricing, the size of the loan, things around. Most loans, ideally, it's also one of the C's is your collateral. What are you using to collateralize the loan? You have to be mindful of, most people quickly sign a loan agreement without actually spending time to look at it. And you may not be the best person to understand it, but try and find a good lawyer or a good finance person who can look at a loan agreement you're about to sign and scrutinize it. It may not be that you can change the terms of it, but if you are aware of the risks or the things that are embedded in that agreement, it helps you in terms of how you manage that loan and how you protect yourself, from a hawkish type lender, of which there are many out there in the market. So looking at the loan agreement very closely to have a clear understanding of, what that is. Some of the things people don't realize, some of the pitfalls, just speaking specifically in the agreement, is that usually in loans, they will have what they will call a default rate, whereby they say if you don't service your loan as and when due, the rate at which they will charge you will be escalated to a default rate, which can be 2 times the original rate of the loan. And what that does is it accelerates the rate at which you are owing that person and puts that person in a position where they basically are controlling you and your business. So always look at it and negotiate your default rate. Don't just accept what they have there. Push it as hard as you can, but having done that, be aware that once you default on your repayments, the default rate applies. 2 is never be afraid to ask for a restructuring of your loan. Businesses go through, never be afraid to do that, because businesses go through challenges, difficulties. Nothing ever happens exactly the way you planned it to happen. There may be things that are outside of your control that influence and impact your business. As a good borrower, you can go back to your lender and say, look, I'm in a tight position. I have these difficulties outside of my control. I would like to restructure my loan. And you can restructure that loan by, extending the tenor, seeing if you can get a concession on the rates, asking for a pause in terms of your repayment. So always manage your loans carefully, consciously, intentionally, carefully. And then, because what you want to do is to keep a very good record of somebody who does not default on his debt obligations.
I love the way you just ended this, especially when you talked about business owners should be mindful that they can renegotiate this loan midway, because I've had stories about people who had issues, who didn't know what to do, of course, and even I've had an instance where someone knew what to do, made effort, but the bank was just playing around. So in that case, where it seems as though either the financial institution or the lender is beginning to make it frustrating for you to be able to renegotiate the loan, what would you say?
It happens. You can't take away from that. One thing to note is that if it's a bank or regulated lending institution, they are often required by the regulator, the central bank or whatever regulator, to make what we call provisions for their loans. So basically, in their loan portfolio, they've lent out to several people, they have a portfolio of loans. One of the things the regulator monitors is how are people repaying that loan. And if people are not repaying as and when due, the regulator, the guidelines requires them to make provisions, basically to take a hit as though that loan has gone bad, and in various categories. So banks don't like that, because whenever they are analyzing whether a bank is healthy or not, they look at your provisioning, how much of your loans are actually bad. So really, the banks won't tell you, but they actually have an incentive to make sure your loan continues to work well. But in a negotiation, they will push as hard as they can because they need to make money from what they've given to you. But if they see you as a good lender, somebody who has always met his obligations, not somebody who is playing games, and you take money and then midway you say, I want to negotiate, even when you haven't managed the money well, bank often will listen because they want to keep you as a customer for more borrowing, and at the same time they don't want to have to make provisionings in their books so that their portfolio is bad. So yes, there are hawkish lenders, and that's why when you're even, one of the things I didn't mention it, but when you're even going to borrow money, you have to look at who am I borrowing money from. It's not everybody you take money from. There are hawkish lenders, but in principle, banks would be looking at lending to people who are good borrowers. And when good borrowers go into difficult situations, they will be looking at seeing how to work with that borrower to work things out. The moment you have one that is not willing to work with you in that manner, you may need to struggle your way through, but it also gives you a sense of this is not the kind of person you should be taking money from any longer, because it damages your record and damages, the business as a whole.
So are there challenges looking at investment now, equity contribution, are there challenges that type of funding poses to a business? And if in investment funding, right, what are those things you can advise entrepreneurs to look out for when they are trying to seal a deal to the point where they can say, yes, we've sealed the deal? When is even the deal being sealed? Is it when the document is being signed? Is it when the money lands? Is it when it's being disbursed? Because there are so many stories about it was supposed to be disbursed in phases. I've heard of stories of entrepreneurs who are even beginning to lose shares of their that they own in the businesses, and counterclaims. I've had the investors, the business owner saying, we had an agreement, you were supposed to bring in so amount at so time, you brought in this much but you did not continue. The investor says, well, we had an agreement, we were supposed to see this much but we didn't see this much, so we decided to withhold. And the game playing keeps going on and on, but the business is suffering somehow, because of this. So what are those things you would say that business owners should look out for? Point to the point it's inked. When will you say the deal is really there? Is it when it drops? Is it when it's fully disbursed or so?
Yeah, it's a very good question. And I'd mentioned earlier on, equity investment is one of the most sensitive type of investments you can get into your business. It's also one of the most expensive. It's the most expensive form of capital. And part of the reason is that you're not only taking money from somebody, you are going into a marriage, and it has wider implications. Some of the key things I will mention is that, first of all, in bringing in an equity partner, always look beyond the money. People often go to people who have a lot of the money, which is great, but always think, what else is this person bringing? Let money come with meaning or with something more. For example, you want an equity partner who can understand your business. The person doesn't have to be in that sector, but is interested in understanding your business and not just interested in, okay, when do I give you the money? Is thinking about how you can support your business, can bring something to the table, whether it's business development or accounting expertise, or helping you with some key client or whatever. You want something beyond the capital, because if the person does not key into your business, you would always have problems down the line. And one of the things that the destruction that has come to a lot of well-meaning businesses have happened because the wrong equity partner was chosen. So be very, very conscious about the equity partner you bring in. So that's one. Two, in going into the agreement, touching on some of the points that you made, into an equity agreement, there are a couple of things that you need to be clear about. One is what portion of that equity, because when you do an equity investment, they are taking a certain portion of your business. What portion of that business is that money coming to take? You want to, as much as possible, try as an investor to balance between getting the right equity investor in and just being headstrong with respect to the valuation of your business. And where you don't have clarity or agreement on the valuation of the business, there are other forms of capital attraction tools that you can use. I mentioned convertibles the other time, where you can actually still take the money and you worry about valuation when it's clear that what valuation really is. So you want to think very carefully around what that's going to come to do with your business. Also, usually equity investments ideally should come with a shareholder agreement. That shareholder agreement will outline the relationship between yourself and the person who is putting in the equity. For example, do they get a board seat, and what kind of board seat do they get? What kind of things are decisions that must be made by consultation of both parties? Or what kind of things are the things that are decisions you can make? What control mechanisms do you put? What are the penalties for people failing to meet their obligations with respect to the equity investment? So they just touch on the point that you make. Usually in a shareholder agreement, it will state when somebody is supposed to put in money, and the person fails. It also introduces penalty for failing to do that, because you are looking at protecting the business, and you don't want a scenario where somebody says, I'll give you 10 million naira. He gives you 1 million naira and doesn't give you anything, but you've been banking on growing the business on the 10, and then he says, well, I'm coming. There has to be penalties in place in the agreement that is agreeable with respect to that. Similarly, he as the shareholder or she as the shareholder would also want to make sure that there are things that make sure you as the business owner or the CEO meet up to certain level of standards for their money to also make sense. So the shareholder agreement is an important document that you have to look at closely, and if you need to get the help of a lawyer or a commercial person who understands how those things work to advise and guide you through that, please do, because once that relationship you are going through is one that can make or break your business.
That's wisdom. That's wisdom. I mean, you don't have to continue to struggle about these things in silence and struggle about it alone. I mean, he said a key thing there. Reach out to somebody. Reach out to maybe somebody who is knowledgeable in finance, in law, that can be able to put those things in right perspective and helps you to a lot to avoid issues that can come your way in that business dealings with the investors. Okay, so I think we can wrap it up with this. There are, for a business, there are businesses that people have gone all out there looking for how to ensure that they get the necessary funding. Okay, and they are doing so well, making progress, and of course, maybe they've even gotten it and they are doing so well in making sure the business, delivers. But for someone who now wants to get into business, or is even in business and is considering most of this funding, equity, contribution, investment, or debt, what should be the paramount thing in your mind? Is it profiting? Is it growth, right? Because I've read stories about companies, especially most of these tech companies. In fact, let's not even travel far about the technology companies of the Facebook, the Twitter, and the likes of them, who for several years, over 10 years, it wasn't as though they were declaring any profit and all that. But of course, over time, you can see that the value of their business, their company has changed. So, whatever it is you have in share has changed over time, but there's nothing written anywhere that you can see where they're declaring profit, where they're doing profit sharing. Okay, but when you find, like you mentioned, somebody who wants to bring in money into your business is also mindful of the fact that he's able to get the money back and even the returns, right, on it. I mean, something must come in terms of the profitability. So what should be the business owner's endeavor, a kind of effort in his business, struggling to make sure there's growth, or when he sees that, this growth can be at the risk of being able to deliver, like you mentioned, also at a point that somebody can get the funding, maybe in terms of debt, and he's able to just make a little margin, right? But he's ensuring that the business is growing. Okay, and when the business grows, he's unable to make that margin as expected. Somehow, he might not be able to deliver in terms of maybe expected returns, expected profit that's supposed to be. So what would you advise the business owner on?
No, it's a real good question, and one that particularly in our environment is very clear, especially when people want to raise money. So first of all, there are different kind of investors. So there are investors who are dividend driven. So basically, when they put money into your business, they immediately want to start getting the return. and start seeing cash. So every year they'll be asking you, you haven't paid us any dividend, you haven't paid us any dividend. Most entrepreneurs want to keep money in the business to get the business to grow. But there are also other type of investors who are not dividend driven, but they are growth driven. So they are what we call value investors. So they focus more on, they want the money to stay in the business so the business can become bigger, and then there will be a point where they exit the business multiples of what they put in. Yeah, which is, I fall into that category, by the way. It's the best way to invest, in my view. But the challenge we have, particularly in our environment here, is that the bulk of our investors in the market are dividend-driven investors. In fact, if you look at the Nigerian Stock Exchange, a lot of stocks on the Nigerian Stock Exchange are undervalued. The reason they're undervalued is not because the businesses are not growing, but it's the determining factor in the Nigerian capital markets is whether you are paying dividend or not. And you really can't blame the investor, because in our environment, we have a lot of socioeconomic issues. So I have to, pay rent, pay school fees, I produce my own water, I get my own electricity, health bills, and all of that. We are in an environment where the need for cash on a regular basis is high, because socioeconomically we are not there. So when somebody is making an investment, they want to see cash quickly. Just because of the environment that you are in. In other climes, other environment, the pressure for regular cash flow is not as pronounced as you have in our markets. And so they are more value inclined. They can keep money for a longer period of time with looking at an exit. It's an issue that you can't say, you can't put a blame on the investor. But what you must realize as an entrepreneur is that there are different kind of investors. So when you are going for that equity investment, you have to ask yourself, what kind of investor do I need for the business? And whilst it may be difficult in this environment to find growth type investors, that as much as possible has to be your initial target. The kind of investor you are attracting. And by the time you're having a conversation with the person and you're explaining the business and how it works, you will know what kind of investor you are getting on board. Now, if there is a scarcity of that kind of investor, you need to present a plan where you are delivering cash to the investor from what you are making, but conserving cash for your growth. And there's a key aspect of the shareholder agreement, of any standard shareholder agreement, which relates to the dividend policy of the organization. It's a key provision in a shareholder agreement. That dividend policy defines upfront how we will treat money that we make. Some will say we have a dividend policy of paying 30% of anything that we make, and 70% goes into the business. Some will say 100% of what we make. Some will say 0% for the first 5 years, and then 10% for the... So you have to design an approach that meets the need of the investor that you are trying to attract, but at the same time meets the needs of the organization. It's not a science, it's an art. But the starting point is as much as is possible. Unfortunately, you don't have much of those type of investors in this environment. Try and attract an investor that is thinking more growth.
Thank you so much.
Thank you very much.
You've made a lot of things easier for us in this discussion on funding for businesses. It's something that we can't ask for. Couldn't have bargained for something better. I mean, in trying to look for somebody who would dissect this so much well, the way we would love it in this effort in getting people, our business owners, to be aware of those things. You've heard a lot from Mr. Samuel Nwanze. He has spoken so much right from the first episode where we featured him, and he exposed our minds to what funding should look like. He has done so much in having to enlighten us from his wealth of experience and from what obtains out there. I mean, so if you have somebody who has played in those key areas and he has been able to do some investment here and there. He has sat on investment portfolios. I mean, in charge of investment decision making in big firms. You can't ask for something better than that. So it's been an awesome time in this discussion. We are grateful for the way the discussion has been. I want to tell you that whatever it is that you have as an entrepreneur, it is possible for you to get the right funding to help your business to the next level. And if you are just desiring, aspiring to come into, it is also important that you understand how these investments or how this financing and funding works, so that you can make the right decision as you are coming into it. As we take these discussions further in other key areas, because he mentioned the fact that even if someone is going to invest or give you funds in forms of debt, there are a lot of things they would check. Even your books, they would want to look at it. They want to see how you are doing, how well you keep those records. I once heard one day an investor talking about one business they just invested, a foreign investor, and they said that when they were just trying to do some due diligence on them, as little as 100 naira purchase they made, they saw receipts for those things. It meant a lot to them, and they were like, oh, if this business can do this, a lot of things can. So we'll be taking some of these discussions further. It might be in bookkeeping, in accounting, just some things that would help generally, so that we can make best use of the opportunities that are out there for us as a business owner. Okay, till we'll come your way next, please don't forget to click on the subscribe button. You can share also with your friends, fellow entrepreneurs and others. Share with them, let them like also the videos, and also our social media handles all over. We're at Street Smart Lab. Okay, we have them at Street Smart Lab on YouTube, on Instagram, on Facebook, and on Twitter. We also have social media platforms represented even at our website, streetsmartlab.com, where you have the rich resources that can help your business to move on. Okay, so till we'll come your way next time, I am Adeyiga Awomuti, towards the smartest you.